I run a chartered accounting firm that serves over thousands of clients, and the most expensive mistake I see business owners make is switching to a company structure at the wrong time. Some switch too early and end up paying a ton of costs to maintain their company structures even though they don't make enough. Others pay too much tax because their sole trader structure means that they'll end up paying the highest personal tax rate instead of the lower flat company tax rate. So today, I'm sharing exactly what I teach my clients about when to transition from a sole trader to a company structure. This includes the key differences between operating as a sole trader versus a company, when you should consider switching to a company structure, and how to make the transition so you can maximize your profits and minimize your taxes. Ready to go? Let's get started. Most businesses start out as a sole trader as it's the most common structure and the most simple. When you operate as a sole trader, you represent the whole of your business. This structure is simple because it comes with minimal paperwork and low startup costs, but it also means you are personally responsible for all aspects of the business, including its debts. Obviously, when starting any business, the goal is to grow. And if you're starting a business as a sole trader, sometimes the business can grow to the point where a simple structure becomes unsustainable. This is usually when you start thinking about potentially operating your business as a company instead. A company is a separate legal entity, so it has its own rights and responsibilities that are separate from yours. There are quite a few tax benefits that come with running your business as a company, and it also has limited liability. But it's a bit more complicated to run as you have to comply with more regulations, and it generally involves higher costs than operating as a sole trader. So how do you know when you've outgrown your sole trader structure and need to potentially consider changing the business structure? There are quite a few scenarios, the main one being making the business more tax effective as your profits grow. A sole trader makes sense for a personal business in the early stages of growth, but if your business continues to grow and your annual profits start to increase into a higher tax bracket, then it's a good time to consider changing to a company structure. Ongoing sustainable growth as a sole trader could mean that you start paying 47% tax on your profits versus a flat tax rate of 25%. But I don't usually suggest making the switch only because of tax rates. The reason is that most people believe that running their business as a company will save them money on taxes since the company tax rate is lower compared to sole traders. But this isn't always necessarily true. And the reality is it's a little more complex than that. The key thing to consider is something called personal services income, also known as PSI. If you're working mostly by yourself, providing personal services rather than selling products, the ATO will want you to pay all your business profits as wages to yourself, which means you'll end up paying a similar tax rate to what you would pay as a sole trader. This effectively cancels out the potential tax advantage of operating as a company. But if your business has a few people doing the same kind of billable work as you, not just administrative work, or you're mainly selling products rather than a personal service, then obviously it makes sense to take advantage of the lower company tax rate. I usually say to my clients that if they're earning over $130,000, then it starts to make sense to operate as a company. Normally when your profits are higher than 130K, then your personal tax rates would be higher than the 25% company tax rate, so it's a good time to consider moving to a company. Anything lower than this amount, the tax benefits of a company aren't a lot, which is why many other accountants will also suggest staying as a sole trader until you're earning above $130,000. The other things you may want to consider before making the switch are how much risk are you exposed to and what growth plans do you have for your business. From a risk perspective, a company structure creates a legal barrier between yourself and the business. As I mentioned earlier, a company limits your personal liability. So the riskier your business operations are, the more likely you are to consider what level of protection you need. It's also important if your business provides physical labor like tradies or is in the healthcare space, because you're going to want to make sure that you have the right insurances in place. And when it comes to the growth of your business, if you continue to operate as a sole trader, you'll find it quite difficult to be able to take on investors as they want security and flexibility of the company structure in place. You may also find that some customers won't engage with you or add to the preferred supplier list if you're not operating as a company. It can also help just saying you're a company because it implies a level of seriousness that you might not be getting as a sole trader. So yeah, those are the three things that you should consider: tax, risk, and future growth plans. If it all checks out and you decide to make the transition, you'll need to first decide on a company structure that best suits your business needs. The most common company structure in Australia is the proprietary limited company. In this company structure, the liability of the shareholders is limited to the value of the shares. It also restricts the number of shareholders to 50 non-employee members. Then, you'll need to get in touch with ASIC to let them know that you're forming a company. They'll want you to update your details and transfer your business name registration from sole trader to company. You'll then receive your Australian company number, which you'll need to then register an Australian business number and a tax file number for your business. Once this is out of the way, you'll need to organize a few legalities. This includes things like creating your constitution, which will be the set of rules that govern how you operate your business, what the shareholder rights are, and what responsibilities the director has. You'll also need to work out the share structure of your company. So, how many shares will the company issue? What type of shares will it issue? And what value will they have? We generally recommend issuing around 120 ordinary shares at 10 cents each. And then, depending on your business activity, your company might need certain licenses and registrations to operate legally. For example, for builders, they need a builder's license to trade. You'll also need to consider registering for taxes like goods and services tax, GST, and pay-as-you-go withholding, which is PAYG withholding. Your accountant and lawyer will be able to advise on exactly what's necessary for your company. Other things you'll need to do is formally transfer assets, intellectual property, and contracts from your sole trader business to your new company. Tell your insurance company about changes to your business structure to make sure your insurance coverage is current. And open a new bank account under the name of your company. You must keep your company's finances separate from your personal finances or the sole trader to meet all legal and tax obligations. Hopefully, this helps you weigh up the decision of when you should consider making the switch. Of course, this is just general advice, so I do recommend you contact the accountant to get tailored advice for your situation. Otherwise, if you want to know more about the benefits of a company or how it compares to other structures like a trust, go check out this video here.